You're about to hear my conversation with our chief fixed income strategist, Dustin Reed. We talk all about tariffs, the External Revenue Service, what's happening in Canada, as well as what's happening in our portfolios. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. I'm your host, Matthew Schnurr, and I'm back with my regular guest, Dustin Reed. Dustin, welcome back.
Hey, Matt. Thanks very much for having me back on.
Dustin, we had talked mid last year, maybe heading into the late summer, early fall, about a potential Trump win and what Trump's agenda really was. And you had boiled it down to four main points: tariffs, deregulation, his tax cuts, and immigration. And 3 days into the Trump term, it seems like you were exactly right on all four of those topics. And I'd like to touch on all of them during our conversation today, and then maybe talk a little bit about impact to Canada specifically. But let's start with tariffs. So Trump's been public on threatening tariffs on Canada, Mexico, China, Europe. Maybe give me the highest view on what has been priced in the markets and what you think the impact may or may not be.
Yeah, for sure. Lots to talk about. It's been a very, very busy news flow couple of weeks, particularly after Trump's inauguration on Monday. So on the tariff story, and this will obviously change, very, very quickly. But as we sit here today, recording on Thursday morning, I think Trump is pretty serious about having something potentially on the books by February 1st, which is the latest announcement, and that looks primarily centered on North America, Canada, Mex, but I would also include potentially continental Europe with that as well as China. When we go back to Trump 1.0, someone showed me this kind of set. I wouldn't call it data, but basically Trump saying, "I'm going to do ABC 2 weeks from now." And he said it over and over and over and over again. And generally speaking, and he used the term 2 weeks from now or a couple weeks from now. And generally speaking, whatever that ABC was, it did not happen 2 weeks from the time at which he said it. So I'm not saying that it's not going to happen this time, but I'm just saying there is precedent, and we all know, or at least most of us that have kind of lived markets through Trump 1.0, we know there's a lot of commentary that doesn't necessarily get put into action. Is it different this time? I think that's obviously what a lot of people are talking about. I mean, maybe to take the Canada story first,
Sure,
because we're obviously sitting here and it's probably most germane to us. Our view on the team has generally been, and this is a bit more of an art than a science, is that 10-ish percent, 10 to 15 percentage points of tariffs across the board for, of Canadian goods imported into the US is probably in the price, and predominantly probably looking at that firstly through a foreign exchange lens, so dollar Canada. Right. But I would also probably include fixed income in there to an extent, insofar, particularly the front of the curve, a little bit with the bank, although I don't think it's totally properly priced. But the currency seems to be kind of the main vehicle of the big three: equities, fixed income, and FX. FX seems to be the main vehicle to kind of message these things and where you see the most volatility. And FX vol, when you think of cross-asset vol, FX vol has been significantly higher than, say, credit vol or rates vol or equity vol. Like you're seeing it manifest there. So I think that's what's in the price. And we're now sitting here a week and change away from February 1st, thinking about what's going to happen. And by the way, it's probably worth noting that in the executive orders, the pile of executive orders that he wrote or signed Monday into Tuesday, there was the review, like all agencies review how trade and tariffs are affecting your agencies and report back. And it wasn't as well publicized, but it was actually an April 1st date. And then Trump came out and basically usurped that by 60 days and saying, okay, February 1st. So that's kind of where the market is at, and particularly on the Canada side. One of the things I was surprised that we have not seen until very recently was commentary or maybe threats around tariffs on Europe in particular and auto manufacturers. Now we did get something on that in the last 48 hours. But I was surprised throughout the fall that we did not see more commentary on that, maybe over the turn of the year in early January. But that seems to be there. That seems to be there now. And on the China stuff, I mean, I would actually say it sounds maybe a bit bizarre. So in the last 48 hours or so, we've also seen Trump talk about a 10%, and I assume it's 10% increase on what's already there
Sure.
on Chinese imported goods into the U.S. Well, 10% is actually kind of an upside surprise from a good bad, very simplistic perspective, because I'm sure many people recall during the campaign it was 60%,
Right.
60% that was being talked about as that's what we're going to do, and it was sometimes not as clear as it's 60% on top of what's already there. Is it 60% in total? What does that mean for various goods? Obviously, there's the EV stuff also happening in the
Right.
background, and some of the technology stuff happening in the background. But I think the market actually traded just very simplistic, like risk on, risk off. After that 10 percentage point increase China news, market was generally risk on in the immediate aftermath of it, and so equities actually print in the U.S. like S&P printed all-time highs, even in within the basket of all those announcements, not just China but everything, and so a bit of a relief. And we're also seeing, just stepping back maybe one step, maybe not surprising. We've seen this movie before. Every time that we see the tariff announcement or some sort of tariff announcement or threat, the market, and I'm saying the market cross asset, is having it's having less and less impact on cross asset markets. We're not seeing the big step function, price reallocations that we would have seen in the fall. We did see in the fall, and even maybe into the turn of the year. And that seems to suggest that not necessarily that the market isn't believing Trump per se, but now we've kind of moved beyond a headline driver, and now it's more of a show me that it's going to be enacted driver. So anyway, there's a lot to talk about on tariffs. I could go on for the whole podcast and beyond on that, but maybe I'll stop there in case you want to touch on any of that.
Maybe just coming back to your last comment a little bit, where you're saying the market's not moving nearly as much. You've calculated it's something like 10 to 15% tariffs across Canada
Hmm.
built into the price. Um, so, and I guess there's this narrative that this is really the beginning of a negotiation for Trump. And what he's doing is he's taking a hard negotiation tactic, and
Right.
very likely we're going to see tariffs either come down or be a little bit more selectively applied. Do you buy that narrative? And if so, do you think, like, I mean, we're only, as you said, a week and a couple of days away from the deadline. Like,
Yeah.
do you see that happening in that time frame?
It's difficult to see. So one of the, again, you can go on the headlines and just what's happening. The things change so quickly, but in the last 24, 48 hours, one of the things that's come out, I think it was a Wall Street Journal lead, was basic, or at least a scoop, I should say, was that Trump was trying to get ahead of the USMCA review, which is due in 2026. And to your question, part of the reason for leaning on kind of 25% Canada, Mexico, all imported goods into the US tariffs was to not wait until later this year until the review is starting for USMCA in 2026, and to accelerate, pardon the pun in a second, but accelerate the negotiations. And where I find that interesting is that, I mean, obviously, USMCA covers many sectors,
Sure.
but one of the big sectors that it covers is autos, and auto, not only finished product but also auto parts.
Of
And
course.
there's these stories that go around, right, that suggest, and I'm not a complete expert on supply chains in various auto industries, but there's these stories that go around that sometimes auto parts go across the border, four, five, six, seven times
Right.
before they're actually done in the finished good. And that's really interesting because I think that, and obviously not, they're not all like that, but a lot of them are like that. And I think that the auto industry would be, I don't know if it would be the top of the list, but I think it would be massively impacted by an issue, whether it's tariffs or an issue with USMCA, but I'm actually bringing it back to the tariff story. And if you think of who got Trump into the White House, I think there's many sectors of the electorate that got Trump into the White House, and clearly one of them that would put their hand up would
Of
be
course.
union
Sure.
workers, right?
Yeah.
Fight for you, Midwest, all that, right? The whole kind of change in demographics. Generally speaking, maybe 20 years ago, I mean, those votes were solid blue
Yes.
Democrat, and now they've morphed pretty significantly, maybe not entirely, but pretty significantly to red, particularly under Trump, Republican. And for Trump to kind of ignore those people and those people that got him into where he is today with the mandate, of course, would seem quite odd. So when that news came out a couple days ago around, well, it's actually trying to accelerate the USMCA negotiation, and if nothing done, then presumably, 25% tariffs on Canada across the board. Is that a bit toothless? Because you're really going to be going after people that kind of put you to where you are. So anyway, that's kind of part of the thought process is, back to your question, how much of it is grandstanding, how
Right.
much of it is just a negotiation tactic. And I saw that, and I was a little less sure that we were going to see something happen in size on or by February 1st for kind of that rationale.
Fair enough. And that would that rationale apply to the other jurisdictions as well?
In terms of geography, jurisdictions,
Yeah, exactly. Mex
yeah,
and China, Europe.
yeah, probably a little bit less. I do think Trump has a nit to pick with European automakers. I really think he wants to see a lot more American vehicles being sold in Europe, and I think he wants to really change the manufacturing supply chain and bring a lot home. So I expect a little bit more on that side. The China 10% that we were chatting about a couple minutes ago is one of the bigger surprises here. I think that's a very interesting global macro story. Maybe not necessarily for this podcast, but this idea that from a very very 30 or 50,000 foot level, I mean, Germany has had a really tough time. I'm sure many people know Germany economic growth was not great at
Sure.
all in 23 and 24. German export model. Some people would say, not all, but some people would say, the German export model was built on the back of cheap natural gas being piped in from Russia. Well, guess what? That's not happening
Right.
anymore. And selling those exports, German and European exports to China, which has also obviously had a rough time from a macro perspective. So that's a really kind of interesting kind of macro thing that's happening. And then you kind of have what we talked about just now with Trump tariffs, autos, other goods potentially as well. So I think that's a really interesting macro theme for maybe later this year that you and I will chat about maybe on a later podcast. But
Great.
I do think there are other regions globally that are going to be very much wrapped up into this. And then another view on it as well is, and this is one of the things I was saying at our weekly macro PM meeting, is Canada as collateral damage, right?
Yep.
The real focus from a border perspective, it seems to be generally Mexico, right? I mean, obviously there's the Canada side too, and they're focusing on it, but this idea that, okay, well, if we're talking about Mexico, well, we might as well just talk about Canada too.
Right.
Even if the issue is predominantly the rationale, rightly or wrong, is predominantly emanating from the southern border as opposed to the northern border. But if we're talking about Mexico, what's the downside of us just bringing Canada along with it? So it's a little bit of kind of, is Canada collateral damage as part of the tariff negotiations? Not that that necessarily matters for end consumers like us,
Yeah, of course.
or
Sure.
what the bank has to do, or how the government has to strategize, or how markets trade. But could that actually be happening behind the scenes? I would not be surprised.
Let's move off of tariffs directly and talk about how they intend to collect all that tariff money with the formation of the External Revenue Service. Tell me a little bit about this and what implications you think that may have for markets.
So this is a really interesting point. it sounds a bit academic, and we've talked about it a little bit before, but I think it's really important for investors. So I think tariffs are coming to some extent. And I think one of the reasons, one of the tells, so to speak, that tariffs are coming is because there seems to be a lot of emphasis to build this new agency, the External Revenue Service. And I think the External Revenue Service is going to stand for a couple of things, but primarily it's going to be there to collect tariffs from foreign countries on goods being imported into the US. And this is important because of the idea that, and we've talked about it before, that the Trump tax cuts, which expire at the end of this year from the first term, but they expire at the end of 25. If nothing is done, then there is going to be a very, very large tax hike across the populace, whether it's corporate or personal or cap gains, as well as SALT, the state and local taxes. If those expire, it's going to be very, very significant. And Trump needs to find a way to pay for the extension of the tax cuts. Congress is loath to vote for tariffs being levied
Right.
because it directly hurts end consumers and the people that put Congress people and senators into the houses of the chambers are directly impacted. It's too close for comfort. So a lot of the farmers would be very, very upset.
Right.
On the agriculture side, and auto workers, we just talked about that. And so all those things. So Congress is very loath to use tariffs as a pay for, and Trump knows this. Trump knows this already. So how do you collect the money to basically offset, or at least partially offset, the tax cuts? Well, you collect it somewhere else and you funnel it through the treasury, and then you use the treasury money to offset the tax cuts. And some people would say, well, maybe they don't need to raise it. Well, they don't need to raise the funds, so why bother? Well, the issue is that obviously the U.S. and a lot of other countries, to be fair, have been running a deficit and have significant debt.
Sure.
And we've talked about this as well. US debt is kind of at 13, 14% of GDP at these levels where things can be a little bit challenging in terms of ratings and currencies. Although the US is a little bit different. But if you saw it in other countries, you would see problems with their sovereign bond curves and their currencies. And so the risk would be that the Treasury would have to issue significantly more debt when you have just simple economics, when you have more supply and the same demand, or more supply and less demand, that generally means prices go down. Well, in fixed income terms, when prices go down, yields go up.
Right.
And so then the term structure of interest rates or borrowing rates becomes a lot more expensive. And so Trump and his advisors know very well that if you have a big move higher in the back end of the yield curve, and even the whole yield curve, but particularly the back end of the yield curve, it's going to be extremely problematic for the long-term health of the U.S. economy. So they can't necessarily add to the debt in size. And so how do we cut taxes without increasing the debt materially? One way to do that is tariffs. Oh, but we can't do that through Congress. Okay, so we need to set up another source. So let's set up an external revenue service and collect the tariffs and funnel it through
I
Treasury.
see.
So that is kind of all the links in the chain. Why are they doing it? How are they doing it? What are the risks around it? And so I think it does sound a little a little gimmicky, like, oh, ERS,
Yeah.
okay, that's funny, etc. But there's actually a little bit of method to the madness. And I mean, we'll see. Well, TBD if it actually works or not. But that's the broad idea of why is this happening, and and does that mean that tariffs are probably going? I mean, the forest of the trees is, tariffs are probably happening, and we're going to do it because they need to collect it. They're not just doing it just to be difficult and a negotiating tactic, because they want to get TCJA, the Tax Cut and Jobs Act, from Trump 1.0, which is the tax cuts. They want to get that extended.
And we had talked on the latest Get Sharp episode with Marco Papnick talking about this topic specifically and constraints and all of the like.
Right.
And there was this degree of requirement to be funded, and Congress not being as pliant as perhaps people are expecting on extending the tax cuts. Where we stand now, what's your view on those tax cuts getting extended? Will it have to come with some sort of augmentation, or is it more of a wait and see if they can actually bring in the revenue that you just described via tariffs? What's the current state of play there?
Yeah, that's a good question. It's still very close, and we haven't really had the sub elections or the by elections
Right.
from the people that Trump particularly plucked out of the House to be part of his cabinet. Um, I think it will be a bit. I think it'll get done, but I think it will be a bun fight, and I think it will. It's not as clean as, oh, there's a majority, albeit a very small majority, but there's a majority of Republicans, so it'll get done. I think that there are at least two factions on within particularly the GOP in the House. And there is a faction, and Marco was talking about this too, to a point,
Yeah.
that they're very, very fiscally conservative and do not want to add to the debt. And they, I think, also to his point, I believe, will want assurances and maybe even some I don't want to say money in the bank, but at least some understanding that ERS, or what is to be ERS, External Revenue Service, is actually taking in revenues that will be able to offset this tax cut,
Right.
or presumed tax cuts. So I think it's close. The initial view was, from the GOP and Trump's camp was, oh, let's get this done in 100 days, first 100 days, which is basically April. I always thought that was early,
Right.
and that was before they started plucking people for the administration from the House. Then I started thinking, maybe later summer around the debt ceiling X date, which is fungible to be fair, but probably has an August date on it at this point. We'll see where tax revenues come in for the government, particularly around the April 15th date. And they're still pushing and saying, no, we're going to try and get it done in Q2. So it is kind of front and center. We need to wade through the tariff issues first, I think, as kind of a market driver, and that was always the top of the four things list that you started off the podcast with. Tariffs was always the top one. But I think we'll be pivoting from a market perspective, from a driver perspective, to the ping pong about what the tax cuts are going to look like, when are they going to happen, and those sorts of things. I mean, obviously, very important for equities is the corporate tax rate,
Of course.
and will the corporate tax rate get done and cut from 21% to 15.15%? Because I think a lot of people. I'm not an equity analyst per se, but I think a lot of people believe that that is effectively expected, and it's baked in the cake for a lot of equity valuations, and one of the reasons equities continue to trade well. So the risk to me, and maybe obviously, is that it doesn't get done. I'm not saying it won't, but I'm just saying from a risk reward perspective, or
Right.
a risk parameter perspective, seems like if it doesn't get done, then maybe some of the air, depending on many, many other things, of course, but maybe some of the air has to come out of the equity tire, so to
Sure.
speak. So I think that, so it's very, very important on there, and obviously cap gains on personal stuff, on salt, which they're talking about
Right.
raising from 10,000 to 20,000, which is a big deal,
Right.
particularly for those states in the Northeast, the tri-state area, New York, New Jersey, and Connecticut.
That's great, Dustin. Good comments. Let's leave the U.S., albeit hesitantly, because there's so much happening there that is so important. But let's talk a little bit more about Canada.
Sure.
And I think there's two big things happening in Canada right now, from my perspective at least. One is the obvious political situation with Liberal leadership race underway to replace Trudeau. And then also the most recent inflation data coming in softer than expected. So maybe choose which one you want to start with, but give me your view on either one of those.
Maybe the political side first. So Canada politics is generally not a market driver, has traditionally, but this time, always dangerous, but I'll say it anyway. This time could be different.
Right.
And the reason I think it's different, and we've talked about this a little bit before, is that I think that if we have a conservative government here, and maybe the most obvious thing I say all day, it would be quite a bit different pathway in terms of policy going forward. And I think the world is, maybe unfairly, but the world is quite bearish on Canada. Some people max bearish, but generally it's pretty bearish view. It's kind of like China at the end of September. I mean, many people were max bearish China, and I think that depending on what happens here, and I do think that it's very likely we'll see a conservative government. But depending on the policies and how quickly they roll out, I think Canada globally optically is going to look very investable again at some point, and that has can have a really big impact on FDI, foreign direct investment, on the currency in particular,
Sure.
Canada CAD appreciation against not only the U.S. dollar but maybe other currencies as well, on immigration, which I think has taken. I mean, obviously there's still big immigration happening, but generally over the last 12 months we've seen a lot of stuff that we haven't seen for a long time, which is I came to Canada, I gave it a shot. I can't make it work. It's too expensive. I'm going somewhere else, or I'm going back to where I came from.
Right.
So maybe it makes it a little bit more, a little less around that. So the housing story obviously dovetails to that. So I think there's a lot of interesting things coming from there. But on the election itself, obviously, I think liberals need to not need to, but party rules effectively. Say March 9th, we're going to have a new leader, if not before. And I think it clearly is coming down to two people. Maybe no surprise,
Sure.
Freeland and Carney. Both are eminently qualified, maybe for slightly different reasons. Obviously, Freeland's been around for, I think, in politics for a dozen years or so, and has been in cabinet for, I think, almost a decade, at least until December when she resigned the cabinet post. Carney, I mean, speaks for himself, right? He's a PhD, Oxford, Goldman, Bank Canada, governor, BOE governor, Bank of England governor, done a lot on the climate side. Chair of Brookfield Asset Management. So foreign reserves, where I worked at Bank of Canada, reports into Ministry of Finance, and he was the I forget the exact level, but assistant secretary or assistant minister, and he was effectively like the boss's boss, so to speak, for a little while I was at the Bank of Canada, kind of overseeing the Foreign Reserves Fund, while on secondment to Ministry of Finance. I mean, he's exceptionally bright, and they both are. And it's interesting; they're both, as I'm sure most people know, but maybe some don't. They're both from Edmonton, Freeland and Carney. And Carney, I think, is actually a godfather to one of Freeland's children. So
Oh
that's
wow.
uh, that's an that's a that's
There
an
you are.
awkward house party. So we'll see how it goes. My initial view, and I could be wrong here, but my initial view was that Freeland would probably have it, although it would be a real race, and it would be close. Mostly because she's been in politics for a long time and has credibility inside the party, and I think probably can debate the job she did or didn't do, and what she decided to do, obviously in December, resigning from cabinet. But I think she garnered a lot of respect from people inside the party for doing what she did. And I think around the country too. I mean, Mark Carney's obviously has an exceptional resume, but he hasn't particularly been in politics, and he's obviously not even a sitting MP.
Sure.
So there's kind of that question of, okay, well, this guy's coming in, and on the one side, it's almost Trumpian in a way. I have no political experience, and it's totally fresh. But I've got here's my resume, and you can take it for what it's worth. So that works both ways, right? But anyway, I've been leaning a little bit more on the Freeland side, like she'll have it. But I've seen more people actually put their names behind Carney over the last week and a half. Not massively, but it's probably scaling probably 5 to 3 or something like that. For every 5 Carney gets, Freeland gets 3. But we're not in the bulk. We're not in the meat of the race yet. I mean, that's February. So let's see how it goes. Regardless, I think both of them are going to have a tough time against the Conservatives. Although I think Carney, given what's happening with Trump and tariffs and all that stuff, Carney probably has a better chance of doing well. I think the risk for the Liberal Party is, are they going to be relegated to not official opposition? Right?
Right.
Could the NDP or even the Bloc be official opposition? So part of this is markets, part of it is water cooler. I mean, if it's all kind of a big round and round, and then, okay, well, the Conservatives are there anyway, so it doesn't really matter. I mean, it's I don't want to say it's not important. It is important, of course, for the country, but from markets perspective, it's
Sure.
probably not a big deal. But I
Yep.
do think that it's something we'll keep an eye on. There's also a little bit of discussion. There's a rumor, whisper, that Carney made a deal with Singh, and that if Carney won, that Singh wouldn't necessarily bail on the government and we'd actually get to October, we would not have an early election. I don't really put a lot of credibility behind that whisper. So we could. Is it possible that we could be running with a liberal government under a new leader for 6 months? I mean, it is possible, although I think it's less possible than the other way around. But yeah, that's how I'm looking at it. I mean, at some point here, not to repeat, but to go back to the beginning of the question. At some point here, Canada is going to look very, very investable, very likely, and we want to be ahead of that from a trades perspective. Whether that's, I mean, we're a fixed income team, so I mean, particularly FX, credit, and rates, and we spend a lot of time talking about that, what the timing is like, the various scenarios, and how to position the portfolio for that.
Yeah, well, maybe we dive into that right now. Although I am feeling somewhat optimistic that in enough time, once enough time's passed, Canada will be investable again. So
Yeah, yeah,
there's the bright side.
right.
So let's go to your portfolio, and maybe you can bring in comments on Canadian inflation if that's impacted any of your positioning, what you expected of the BOC as
Sure.
well. But what's happening in the portfolio? How you're positioning things?
Yeah, so maybe just quick on the inflation side. We did have the Canada inflation numbers. They were kind of in line with expectations. Minus zero point 0.4, I believe, on the headline on the monthly, which is not seasonally adjusted. So it gets whipped around by energy prices pretty significantly. The year-over-year number, I believe, was 1.8. Now, Statistics Canada said something really interesting at the end of the data dump, so to speak. It basically said that without the GST tax holiday, annual inflation would have been at 2.3%, but instead it printed at 1.8. So a half a percentage point, obviously, knock off on the back of what it calculates, which could be wrong, of course, but what it calculates as the impact of the GST holiday, which are obviously still in as we record this and goes till mid Feb if it doesn't get extended beyond. So that's interesting. So I don't think it particularly changes the Bank of Canada's outlook here. I've been on a view for a long time, as we've talked about, that the bank's going to be cutting significantly and needs to get into at least the midpoint, if not to the bottom half of what the bank considers the neutral range. So 3.25 right now is where the policy rate sits. That's the very top end of the 2.25 to 3.25 Bank of Canada's expected neutral range, where rates are not are neither accommodative nor restrictive. I think the bank will cut on the 29th. It's a double day, by the way. We'll have the Fed and the bank on the same day, but I think the bank will cut by 25 to take the key policy rate, Bank of Canada's key policy rate, to 3%. And I think we'll see more after that. And what I just said a minute ago has nothing to do with the tariff story.
Right.
If I'm totally wrong on the tariff story, and we see monster tariffs on February 1st, bank's going to be in. Bank's going to be in quickly, I
Sure.
think, and the bank will be cutting, even though it's inflationary in the short term. I think the bank will be looking at it from a medium-term aggregate demand shock,
Right.
and want to get rates quite low, so below 2.25, which is where rates start becoming accommodative. So I would expect to see 2% or below relatively quickly by probably middle of the year, which the market is not priced for whatsoever. In terms of portfolio and how we would manage kind of not only that but everything. Again, we are spending a fair bit of time talking about this kind of Canada investable optics globally idea and thematic, and how to skew that, and what does it mean. I think not to talk around too many corners, but that's part of the particularly economics, but it's definitely a markets game too. We could see some more challenging obviously times for Canada before we see that light switch flip on. So we don't particularly have a lot of trades on from that perspective. We do have a small a currency trade on that does message that. We have what's called a digital knock-in for dollar Canada, where basically the USD CAD, so Canadian dollar, has to depreciate to a certain level for the option to be live, and then the Canadian dollar has to appreciate to a certain level to make money. We don't really have a lot of those trades on quite yet because we think it's a little bit early, even though we're getting prepared in terms of kind of the rates and credit story. Other things that we're doing in the portfolio, I mean, we're relatively neutral on U.S. duration here. Just the volatility is a little bit challenging, and we do think that the market is kind of consolidating after obviously having a big move higher in yields between kind of mid December ish and mid January, and now it came down a bit, about 20 basis points, at least 10-year treasuries, and is in the process of consolidating. So that's a pretty neutral view for us. We've been keeping some of our real duration exposure on the idea that inflation in the US in particular is going to remain a little bit hot and the Fed's going to be on hold here for a little while. So we like
Right.
getting some of our duration not only from regular nominal yields as most people would look at, but also real yields. We think even though break evens have moved quite a bit higher, we think that it still represents pretty good value. We've traded out of a lot of our EM. I mean, the very, very back of the envelope EM is, if the US dollar is rising and US rates are rising, you generally don't want to be
Right.
owning EM, either FX or local currency. So we were ahead of that and sold a lot of our EM positions, particularly in South Africa and Mex in Brazil. We do hold some Indonesia, but it's relatively small. We've been kind of in and out of the UK story with the fiscal there, a little bit concerning. So we were picking up some duration, but we've been out. And probably our favorite global duration exposure from a macro perspective here remains New Zealand. We've been relatively constructive on New Zealand. We think that the RBNZ, the central bank, is going to be cutting rates pretty aggressively. They're in a pretty significant recession, and inflation looks to be on the downside. So a lot of it is in the price, to be fair, but from a yield capture perspective, it's pretty good, particularly versus Canada, and we're relatively comfortable. I mean, obviously, sitting in Canada, it's generally in New Zealand CAD, which can obviously bounce around, but there's a much higher correlation between New Zealand and Canada dollar versus the U.S. and Canada dollar. So
Right.
we actually have a lot of it hedged anyway, but we like that. We like that from a duration perspective. So we've been buying that in unconstrained and our global funds in particular. So the credit story, obviously, we're we're a little bit concerned about some of the credit on the Canadian side, given kind of just the near term outlook on the economy, as I'm sure most people expect, and some of the paper, and particularly the very high yield CCC space, we've been shying away from and skewing a little bit more towards kind of the 5 and 7 year spot on the curve, and not doing massively long end duration around 30 years on the concern that, if we do see, despite what I said before, if we do see a bit of a spike at the back end of the curve, obviously going to probably drag everything up there with it. We don't want to necessarily be a part of that. So we feel a little bit more comfortable kind of in the 5-7 year neighborhood. But that's a number of the trades that we have on. There's a lot more that are going on. There's lots to play for. Like I've said many times, I think this will be a fantastic year for macro trading and a lot of opportunities for investors and our clients.
Undoubtedly, it's off to a very rapid start. So we'll leave it there and look forward to our next conversation, Dustin.
Thanks very much, Matt.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.